Hello, let us look at leases. And a lease is a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Okay, let us understand what this means. Okay, when we have a lease contract, there is usually a lessee who is the owner of that asset. Okay, let's say, for example, a building. Okay, what they do when we have a lease agreement is they transfer rights of control. They transfer the rights of control of that asset, okay, to the lessee. Okay, so the lessee gets the right of use of that asset, but the ownership, the lessor remains the owner of that asset. Okay, so they transfer the rights of control of that asset for a certain period of time, for a certain period of time, a certain period of time. Remember, it could be a building that the lessee, let's say it's a company, they want some office space, so they get into a lease contract with the lessor, where they request, can we have the office building for 5 years, payment annually this amount of money. That's basically how a lease contract is. Okay, and in exchange, you hear there is a certain payment from the lessee to the lessor. That is what, from the definition, we are calling in exchange. There is going to be consideration, which mostly it's just payment in cash. Okay, so that is why our definition is a contract that conveys the right to control the use, okay, the right to control the use of an identified asset, in this case the office building, for a period of time. That means for, let's say that example, 5 years, in exchange for consideration. This is where the contract dictates you pay the lessor, let's say, for example, Kenyan shillings 100,000 annually, okay, for that office space. So that is basically what we are calling in exchange there. You're considered. So sometimes you pay in cash or whichever form of payment you agree with the lessor. So always a lease contract has this attribute of giving out the rights of control of use of that asset for a certain period of time, and in exchange there is something that the lessee gives the lessor. Okay, so in it you can see here we are saying that there is a payment to the lessor, and this is what we call a lease liability. So you can see these payments are done over a period of time. Okay, so when a lessee is paying the lessor, in when we are counting for this over at a certain point in time, we need to recognize the lease liability at every specific time, because this, you can see, it's a contract that is going for more than 1 year. And as per IFRS 16, actually, the exemptions for a lease contract, when we want to apply IFRS 16, is when, if that lease contract is actually less than 12 months, that is 1 year. So it doesn't have to follow the rules of doing the lease accounting, okay, which you're going to understand more. And also for low value assets. These, you can directly recognize them as expenses. You see, for example, when we have a building, we are renting a building, and we pay in advance for 12 months or whichever amount of months you decide with your landlord. Okay, so what we do is we recognize it directly as an expense every month, and prepaid for the months that we have not yet stayed. Okay, so once you stay in May, you account for it an expense for the rent for that May, and then for the remaining months that you have prepaid, that's basically a prepaid expenses. So for lease contracts that have this attributed that they're less than 12 months and they are low value asset, let's say a laptop, then they are exempted from the IFRS 16. But for contracts that are more than 12 months and they are high value, then you have to make sure you understand you account for rights of use of the asset, and you also account for what we are calling now the lease liability. Okay, let's first understand what is lease liability. And a lease liability is the present value of the lease payment that the lessee is obligated to pay over the lease term. Okay, as you can remember from our example, KM Traders is getting into a lease agreement for 5 years, and they will be paying 100,000 yearly, so for 5 years. Okay, and you see the present this is the future value, the future value of the amount they will be paying. It will actually amount to 500 at the end of the term, but now we are looking at the present value of that lease. So we have for example a discount rate of 5%. Okay, so given that, you will be able to calculate the present value of this 500,000. Okay, so you have to look at the present value. If you are looking at the lease liability for this first year, you have to look at the present value of these future payments till the end of that term. And so you'll have to calculate that the present value. Okay, but also there is usually other things that you need to make sure you include, because they are part of that lease liability, which of, okay, the fixed payment are basically these fixed payments when you are paying, so you have to do the present value of it. They are usually also variable payment. Sometimes the list does not dictate for fixed payments, like here stating 100,000 annually. Sometimes it is recalculated depending on inflation. Okay, so also variable payments are, you also include them when you're calculating the lease liability, if that is the type of the contract you have. Then we have something we call the residual value guarantees. So sometimes you guarantee the lessor the value at the end of the term, the value maybe they expected the value of that asset once reevaluated to be 100,000, but you tell them, I guarantee you it will be at 90,000. You can imagine this asset, for example, if it is a motor vehicle that you have leased and you have been using it, so you're just trying to say we are going to try to maintain it. Okay, so you say we are going to guarantee you it won't go below 90,000, but at the end of the term, actually that motor vehicle is evaluated at 80,000. That means you're going to incur a cost of 10,000. Okay, because you guaranteed that it won't go below 90,000. This is a cost also that is arising from this lease. So once you can predict this cost of these 10,000, that is an expected payment because of your guarantees. Also, it should be included in your what we are calling the lease liability. Okay, so that should also be included because it is a cost that is arising from having this lease. Okay, then we have the exercise price of purchase option, which comes about where we have some lease agreements that have a purchase option. And if your intention is to own this, for example, if it is a motor vehicle, is to own this motor vehicle at the end of the period, and you've been given an option where you will have to add, for example, 200,000 to get that motor vehicle, and you intend to own that motor vehicle, then you should also include this amount in your lease liability because you're going to incur this cost. Okay, then the other thing you will find also being added into the lease liability is the penalties for terminating. So if the contract, sometimes it has, if you terminate this before 5 years, for example, you're going to pay a certain penalty, and you oversee maybe operations are going to end in 2 years. or something like that, and you're going to incur a penalty, then you should include this penalty cost. Maybe if they had said 80,000 is what you need to pay if you terminate this contract before these 5 years are over, so you need to include this as well. So these are the costs that or rather the expected costs that bring into the lease liability. Okay, now let us look at the right of use of asset. Okay, the right of use of asset, remember, initially when you get into the contract, you need to recognize the right of use of asset, and it is considered actually to be an asset because you're going to use it. For example, if it is the offices, you're going to use the office in generation of revenue, and it's something you're going to use over a period of time. Okay, so you need to recognize then the value of this asset. You'd say technically, what's the value of this asset? So you need to recognize first the initial lease liability, because you're going to incur all these costs in exchange of being given the right to use this asset. You're incurring this lease liability. So that is one thing you should include. Then the lease payments before or commencement of date. So before, if you had paid anything, maybe you had to pay for, let's say, for example, you prepaid for a certain period, then make sure you have included it, because when you work, if you did prepay, that means you have not included it in your initial lease liability at this point in time. But if you had nothing prepaid, then it's already in your lease liability. So we are saying all payments that relate to this, to getting this list, they should be included in calculating the initial cost of the rights of use of that asset. Okay, so also you include initial direct cost. If you had to seek lawyer services, then you have some legal fees directly that are related to getting these list together and the signing and everything. Then you should also include those when calculating the initial cost of rights of use of that asset. Okay, another thing you need to recognize is the estimated cost of dismantling that asset. Okay, so dismantling not the asset, but let's say, for example, you've been given, you're leasing land and you build something on it. At the end of the period of the term, you need this land should be returned to the lessor the way it was. So if you had developed or add machineries in there, you need to clean up. So that is the restoration of that land to how you were given by the lessor. So that is the cost of dismantling that, for example, that land. You need to add it in your rights of use of asset when when you want to recognize the initial cost of the rights of use of that asset. Okay, you also need to reduce the incentive. Sometimes to make a lease agreement attractive, you'll find the lessor has given some incentives, like you don't have to pay the first this amount of months if it is monthly, or you don't have to pay for the first 1 year. So you see, this is reducing the lease, I'll call it is reducing the lease liability. Sometimes when calculating the lease liability, you need to remember to less the incentive. So once you less the incentives given, then you already find when calculating the rights of use of asset, you've already reduced it, because in the initial lease liability, you have reduced the incentives given by the lessor. The incentives are just, it's like a discount, more of a discounted way, a discounting approach to make the lessee want to get this lease. Okay, so initially, when you remember, this rights of use of asset is basically an asset. Mostly it is over the period of the term that you've been given this lease. Okay, so you need always to, when you're starting, you need to recognize this as your asset, the right of use of asset, and you also need to recognize you also need to recognize the lease liability. And to recognize actually the lease liability, and to recognize liability, definitely you credit to increase it. Okay, so over the period of time you will be depreciating, the ROU. Okay, and this one, as you pay your lease liability, you will be reducing it and paying now cash. So you will need to also recognize the interest, because you are discounting because of the time value of money. You need to recognize the interest expense. So you'll be recognizing the interest expense as you pay. So you will be adding it to the lease, you'll be adding it to the lease liability, and then you also reduce that lease liability when you pay your annually, for example, your annually payments. Okay, so we will do an example in our next section to better understand how does this work. Okay.